All right, quick. Who's the biggest foreign supplier of oil to the United States? Tick, 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 tick. Nope. It's not Saudi Arabia. Okay, I know everyone said it was, but, well, it's Canada, folks, at 61.6%, followed by Mexico at 9.6%, and then there's Saudi Arabia, right? Listen, at only 4.3%. For that reason, my next guest says that this situation is really very different from that 1974 OPEC embargo that a lot of folks on Wall Street are still using as their playbook for right now. Meanwhile, the daily global supply of crude oil is about 107 million barrels. 18.4 million typically go through the Strait. Now, not all of that is being held back. That's being held back, but it's being offset by 7 million from various ways. Saudi Arabia has found some ways. The International Energy Agency, remember some of these barrels we have in strategic reserves. So for now, we've got an offset. We've mitigated to 11 million barrels. Of course, the question is how much longer can those efforts be sustained? So I want to bring in now CIO Group, their co-founder and co-CIO, Steve Wieting. And Steve, first, let's discuss the fact that we get so little oil, from that region than we did and of course, on the Arab oil embargo in the 1970s that sparked that crazy inflation in the Arab period. And even to this day, it reverberates, whether we're talking about foreign policy, Federal Reserve policy, because of all the mistakes that were made by Arthur Burns. But we have to look at it through a different lens, right?
Well, look, if you wanted to see decades of decline in oil production, early 70s. If you wanted to see another one, 2008, we reached $148 a barrel. We had crushed American energy output, and at that point, we were very vulnerable to oil shocks. This time around, it's not just a perfectly easy pass because energy commodities are fungible. We could export some energy-related products, and that pulls us up. But you can see a really wide spread between the global price of oil and the U.S. price of oil because we're at record high production.
Yeah, I think Oman oil, it's $160 a barrel versus ours. I mean, to your point, Brent is always as a premium. And so the question, though, is we know that oil prices aren't going to go all the way back down, and that there are opportunities here. Not all oil stocks move in unison, right? There's a couple of subcategories to the S&P oil sector, and there's even like midstream, upstream. Talk about that for a moment, where the opportunities could be even beyond this period.
Well, you look at what happens with these shocks, and I'm only going to give you a scenario. 2022, we had to redirect oil and energy flows around the world with the invasion of Ukraine. And we hit $128 a barrel on Brent, but we did that very quickly, 1 month into the conflict. So the crisis price is an exaggeration, and then it comes down. Now, take a look at what oil futures show. Roughly 12 months from now, the oil price is expected to be about $80 a barrel.
Right.
So do you want to necessarily just invest and say, well, oil can only go up? If you don't, you've got the opportunities in some of these energy transmission pipelines, natural gas exports, things that are in a secular rise inside the U.S. economy. So we're thinking about, midstream energy partnerships, an example. We put those on as an overweight prior to the attack.
So I know you like Western Midstream is another name that you like. Cheniere is a name that you like. Natural gas. I liked it anyway before. I've liked it for a long time. And I think it was brilliant that we made that sort of investment in this natural gas, considering the need around the world for it.
Well, part of this too, and it's not so much with, LNG, but yield play. And do you want some piece of your portfolio to get an 8% yield?
Right.
And if you invest properly, there could be a better after-tax return for some of these investments. And it's not to say that there aren't other things to like. One of the things that we can talk about is cybersecurity is the same underlying growth drivers as defense shares, and they're off 30%.
Let me ask you, though, just quickly, and I want to shift off of oil, but oil, we stabilized, we pulled back. Inflation worries and concerns maybe fade a little bit. What will it mean for the dollar? What do you think it means, or what it mean for the Fed and Fed policy?
I think the Federal Reserve is going to go back onto an easing track. It's not necessarily going to be a month or two, but it's probably coming. And, again, we have to recognize in the last 12 months, the U.S. added 135,000 jobs. Real after-tax incomes are going to take a short-term hit, we can hope. And so we're going to be very close to a zero real income for a couple of months. So That has to be taken into account here. We're not absolutely shock-proof, and the labor market is in a different place than where we were in April of last year when we had a really rapid rebound in markets. So I think the Federal Reserve is going to focus again on the things that, may outlast, right, the oil shock, and the weakness in the labor market is very evident in survey data.
I hope you're right. I mean, there seems to be a camp, though, at the FOMC that's really entrenched, have locked in on inflation superseding labor. But I do want to get back to what you just alluded to, cybersecurity. Jeffries did this survey, and where if you change your IT budget to allocate more toward AI, where will the money come from? IT services, 71% said we'll take away from that. A large portion say we'll take away from communication, front office. 0%.
Right.
0% will take any money from cybersecurity. And you say with this 30% pullback, you like it, particularly CrowdStrike.
Well, this is just an example of a premier type of company that's pulled out tremendously on fears that AI is somehow going to replace everything. And it's really unlikely that you're going to see enterprises say, well, Claude, can you please do all of the cyber thing for me and we'll be okay.
All right. The way it sounds now, Claude's going to do everything, but we'll see. I don't disagree with you. I mean, I am a little concerned, though, that it was already vulnerable, felt vulnerable, even before the Claude story came.
This was all happening before the situation with Iran. And what's happened in the last month is the price of oil has been responsible for about 50% of all asset price movements in every asset in the world. And so these sorts of corrections were going on beneath the surface, and we think they were excessive in the case of software.
Good stuff. Steven, thank you very much.